When most people hear cartel news, they think crime, they think violence, they think drugs. They think that has nothing to do with me. Economists see something completely different. They see supply chains, they see monopoly power, they see risk pricing, and they see inflation. And here's what nobody tells you. Whether you live in Mexico, the United States, Europe, or Asia, this distorts your investments more than you think. Today, I'm going to show you exactly how criminal organizations break real markets, raise real prices, and why the wealthiest investors on the planet track this information. Stay with me, because by the end of this, you will never read a geopolitical headline the same way again. Before we go any further, this is not about glorifying what these organizations do. This is not entertainment. This is economics. So let's put emotion aside and look at the structure. A cartel, in its purest economic form, controls supply routes. It manages logistics across thousands of miles. It systematically eliminates competition, and it enforces territorial control, like a monopoly. Now, if I replace the word cartel with corporation and remove the violence, what you would have left looks disturbingly similar to a vertically integrated business. Think about it. Barriers to entry? Enforced brutally. Pricing power? Absolute. Control over the supply chain? End to end. This is why economists study these organizations the same way they study markets. Because the mechanics are the same, only the rules are different. Here's where it gets interesting from an investment perspective. When a government cracks down on a cartel, think military operations, mass arrests, supply route seizures, what happens? Supply drops. And what happens when supply drops in any market? Price goes up. But there is a layer most people miss. It's called the risk premium. When operating a supply route becomes more dangerous, the people running it charge more. They are pricing in the probability of losing everything. Sound familiar? It should. This is exactly what happens in oil markets when a conflict breaks out in the Middle East. It's what happens when sanctions hit a commodity exporting nation. Supply shock, risk premium, price spike. Illegal markets respond to enforcement the exact same way commodity markets respond to geopolitical pressure. And those price spikes, they don't stay underground. They bleed into the legitimate economy. Let's zoom out for a moment and talk about what this actually does to a local economy. When criminal organizations dominate a region, businesses close. Not because they fail, because they can't operate. Because extortion becomes the cost of staying open. Because the owners leave. Because the customers stop coming. Tourism collapses. Foreign investment avoids the region entirely, and the people who have capital, the business owners, the professionals, they move it somewhere safer. Economists call this capital flight. Now here's the part that affects your portfolio even if you have never been near these places. When risk rises in a country, investors demand higher returns to justify investing there. That's called the country risk premium. A higher risk premium means a weaker currency. It means higher borrowing costs for the government. It means slower economic growth. And it means that businesses operating in that country pay more for everything, which gets passed on to you as a consumer in the form of higher prices. This is how instability in one country shows up on your grocery receipt. Let me show you exactly how instability turns into inflation. And I want you to follow this chain carefully. When criminal organizations control a region, supply chains break down. Trucks need armed escorts. Transport routes get rerouted through longer, more expensive paths. Insurance premiums explode. Every single link in that chain gets more expensive. What do businesses do when their costs rise? They pass it to consumers. That means prices rise. That is inflation. Here's the critical insight, and write this down if you need to. Not all inflation comes from central banks printing money. Some inflation comes from instability, from broken logistics, from security risk embedded in the cost of doing business. This is structural inflation. It does not respond to interest rate hikes. You can't fight it with monetary policy. It lives in the supply chain itself. And the investors who understand this distinction between monetary inflation and structural inflation make completely different decisions than everyone else. There's one more layer, and it's the one almost no mainstream financial media talks about. It's called the shadow economy, the underground, untaxed, unmeasured portion of economic activity. When a significant portion of a country's economic activity is happening off the books, the government collects less tax revenue. The tax base shrinks, budget deficits grow, and now the government has a problem. It has obligations, infrastructure, services, debt payments, but less revenue to cover them. So, what does it do? Option 1. Borrow more money. That increases government debt and drives up interest rates. Option 2. Print more currency to cover the gap. That devalues the currency and creates inflation. Option 3. Raise taxes on the legal economy. That slows growth and squeezes businesses even further. Every single one of those options ripples through bond markets, currency markets, and equity markets. Crime doesn't just hurt victims. It quietly, invisibly, distorts the entire economic system that your investments live in. So now let's talk about why global investors, the people managing billions of dollars, treat geopolitical instability as investment data, not background noise. When you buy emerging market bonds, you are lending money to governments in regions that often face exactly the instability we have been discussing. You demand a higher interest rate to compensate for that risk. That's not charity. That's how risk pricing works. When you have currency exposure to a country with a weakening tax base and growing deficits because criminal activity is eating the economy from the inside, that currency is going to depreciate. And if you are not hedged, you absorb that loss. When you own supply chain companies operating in high instability corridors, every disruption adds cost. Every added cost compresses margin. Compressed margin means lower earnings. Lower earnings means the stock underperforms. This is how geopolitical risk shows up in your portfolio, not as a headline. As underperformance, you don't understand. The difference between sophisticated investors and everyone else is not access to better information. It's the ability to see the chain of causation from political instability to economic distortion to asset price movement before the market prices it in. Wealthy investors think in probabilities, not emotions. At this point, you have two ways you can walk out of this video. Path 1. You keep doing what most people do. You see a cartel headline and you scroll past it. You invest without accounting for political risk. You don't think about country diversification. And then, when volatility hits, and it will hit, you are surprised. You react. You lose money reacting to something a prepared investor saw coming months earlier. Or, Path 2. You start asking different questions. When you see a country experiencing serious instability, you ask, what is the country risk premium? How does that affect the currency? What supply chains run through this region? What is the inflation exposure? Smart investors diversify geographically, not just across sectors, but across political risk environments. They hedge currency exposure when they have significant holdings in volatile regions. They hold inflation-protected assets when structural inflation is rising in key markets. And they price risk properly, instead of hoping it doesn't show up. That's the difference between reacting and positioning. The next time you see a cartel headline, a crackdown, a territorial dispute, a trafficking corridor disrupted, don't just see crime. See a supply chain. See a risk premium repricing. See inflation pressure building in a region. See currency risk accumulating in the bonds no one is watching. Because here's the truth about how wealth is actually built and protected in this world. The wealthy don't react to headlines. They price risk. If this changed how you see financial news, subscribe. I break down one concept like this every week. Comment below, what geopolitical risk do you want me to cover next?